Hi, welcome back to another current events section for European financial markets. Today, what we're going to focus on is something that was raised in class, and the student said, look, could you talk next week about helicopter money? And I threw in the idea of talking about dual rates as well. These are both central banking techniques, and so it sort of fits in with the very first current events section that we had, where we looked at the financial crisis that almost took place in Europe but didn't, around the 12th of March, when the European Central Bank had its last big policy meeting. What I'd like to do with the helicopter money and dual rates is break it up into the usual 5 questions so that we have some structure to the conversation, starting first by talking about why this is coming up now, giving some sense of what these terms really mean, and then exploring what this tells us about central banking, why we're talking about central banking and not about fiscal policy, and what this implies more broadly about macroeconomic stabilization in Europe, or rather about the politics of macroeconomic stabilization in Europe, because I think it's the politics side that becomes really important. So why is this coming up now? Look, central bank analysts and people who watch central bank have been obsessed for a long time, since the last crisis, with the possibility that central banks will run out of ammo, myself very much included. Now, obviously, the wise old figures in the central banking community have always said that central banks can never run out of ammo, but most of us have looked at this and said, well, of course they can run out of ammo. They can run out of ammo partly for technical reasons and partly for political reasons, right? The technical reasons really probably stem from either a standard way of seeing things, like it's hard to imagine negative interest rates, or just a lack of imagination, right? Because you're used to seeing the way central banking works in one way, and you go, okay, we're heading toward the zero lower bound, and there's nothing below that, right? And so depending on your point of view, it may be that there is something below that. We just not bothering to look closely enough. It's kind of a flatland problem. But I think part of it is also political. Come on, let's be serious about this. Most people are dealing with currency, and they're only dealing with currency out of trust, right? This is fiat money. This is not money that somebody dug out of the ground and then reassured you is a sufficiently rare piece of rock. This is a piece of paper that you're supposed to have confidence in. And people are unwilling to accept a huge amount of uncertainty or unfamiliarity wrapped around this piece of paper. So to the extent to which central bank policy extends ever more deeply into the bazaar, then we can imagine that there are political limits that are going to be swung into place, right? And in both of these things, the technical and the political side, were on full display last summer as the European Central Bank, or rather its governing council, struggled to add to an already very accommodating monetary policy. Now, I say very accommodating with all that emphasis because if you think about it, the ECB's balance sheet is enormous right now. They're committed to renew those assets as they mature, so to reinvest those assets as they mature for the foreseeable future. The deposit rate was negative. They had just introduced a new round of targeted long-term refinancing operations in order to ensure that banks had access to credit. And so looking at it over the course of the last summer, the economy wasn't doing well, but it was just really difficult to imagine how they were going to add to that in some kind of a meaningful way. And nevertheless, Mario Draghi managed. He managed to lower the deposit rate. He managed to introduce a tiering structure. He managed to make the targeted long-term lending operations even more generous. And he managed to restart the large-scale asset purchasing program. And of course, having managed all that and deeply divided the governing council along the way, he left it really hard to imagine what could possibly come next, right? If some crisis happened to hit the ECB or the European economy after that, what would the ECB do? That was the big question, right? I mean, we could imagine talking about helicopter money, which sounded possible, but slightly weird and unacceptable. And when I remember the first time I heard it, when Eric Lonergan started talking about dual rates, that just sounded strange, right? So I have to admit, this current event section. I'm really glad you guys asked this question because it's something I've been sort of racking my brain to try to wrap my head around, and writing this has helped me. So what do these terms mean? Well, helicopter money is when central banks give money directly to non-financial firms and households. Now, that doesn't sound so weird until you realize that central banks don't print normal money. Central banks print central bank liquidity. They print their own kind of money. So what you're going to get if this helicopter money falls into your lap is a piece of paper that entitles you to a certain amount of central bank liquidity. Now, that's not very useful, right? Because central bank liquidity is something that really banks only trade in. So what you're going to do is you're going to take that piece of paper, you're going to deposit it at your bank, and your bank is going to promise in exchange for this central bank liquidity, which your bank finds useful, it's going to offer you real money, right? Or it's going to offer you the opportunity to use something that it creates that looks and works like real money. That you can trade with somebody else, either for real money, cash, or for objects of value, right? But along the way, as you do that, right, they're just going to receive central bank liquidity and they're going to deposit that with their bank, and so eventually, what's going to happen very quickly is that all this central bank liquidity that gets mailed to you in the form of a check is going to wind up back in the banking system. Right? And so the banking system is going to find itself holding a lot more central bank liquidity as a consequence on their balance sheets. And then the question will become, okay, how are they going to distribute that central bank liquidity among one another? And crucially, what is going to be the impact of this sudden expansion in central bank liquidity on economic activity? And the theory is that by giving you central bank liquidity and then getting you to give it back to your bank, along the way, you're gonna buy some goods and services, so economic activity is going to increase, and you're not just going to get your bank to give you cash, which you're going to store under the mattress, right? You're going to use the money instead. So helicopter money is a way of getting you to engage in economic activity, and so bolstering the economy. Well, what are dual rates? Because that helicopter money stuff sounded strange, but dual rates are even stranger. And like I said, this is something that was developed by a number of people, but for me, for my purposes, I associate it with Eric Lonergan because he wrote a really interesting blog piece on it, and because he and I talked about it once in the past. And the basic idea is pretty simple. Central banks have at least two policy rates, right? Usually one of them is focused on the rate at which they pay central banks for money that pay commercial banks for money that commercial banks leave at the central bank, and usually this is the central bank liquidity that I've been talking about, right? So when commercial banks leave central bank liquidity at the central bank, then the question is well, what do they get for that? And they get a deposit rate, which is usually a very small rate of interest relatively. But there's also a rate at which the commercial banks can borrow central bank liquidity, right? And that's a kind of a refinancing rate. And that gives them additional liquidity so that they can meet their funding obligations with other banks, right? Now these two interest rates, the deposit rate and the refinancing rate, there's a third rate in Europe as well, which is a marginal lending facility. It has to do with when banks get in trouble between refinancing periods. But the crucial thing is these two rates are actually used by monetary policy makers to influence one interest rate. And that one interest rate is supposed to be bounded between the two, and that's the interbank lending rate, right? Or more colloquially, the interest rate, right? Now, having said that, it's at least theoretically possible to take two different instruments, right? The deposit rate and the refinancing rate, these two different instruments, and to target them at two different targets, right? One interest rate to influence lending and the other to influence funding, right? So we'll put the deposit rate we'll use to influence funding, and the refinancing rate we'll use to influence lending, let's say, right? You can tell my brain is still not wrapping around this easily, because under normal circumstances, it's kind of hard to figure out what Eric is talking about, right? And so under normal circumstances, I keep regressing back to the idea that what we should really focus on is the interest rate, right, in macroeconomic terms. But in a world of negative rates, right, where we're really talking about taxes and subsidies, right, because a negative rate on a deposit is a tax, and a negative rate on a loan is really just a subsidy, then Eric's point about dual rates is a lot easier to grasp. Let me explain. Look, I was not trained in finance. I was trained in macroeconomics. And in the traditional macroeconomic model of banking is a pull model, right? Where what we look at is banks and their relationship to non-financial corporations. And these non-financial corporations demand loans from banks, right? And they demand loans from banks depending on the interest rate. So when the interest rate is high, the non-financial corporations demand less, and there's less investment activity as a consequence. When interest rates are low, the non-financial corporations demand more, and there's more investment activity, right? And that is the crucial part of the pull model, is that by manipulating the interest rate, we actually manipulate the level of investment activity in the economy. Now, obviously, that money that gets lent out needs to be funded somehow. Now, I say obviously, but Francis Coppola has done some really interesting work in the Twitter community explaining to us that it's less obvious than this traditional macroeconomic model would imply, and that I've had to build into my understanding as well, and I won't try to explain that here, but we can go into that later. The bottom line is, in the traditional macroeconomic model, the deposits are really just accommodating, right? I mean, the non-financial corporations sort of give money back to the bank, as in every loan that the bank lends out to a non-financial corporation becomes a deposit in through the back door, right? And so everybody who's seen the standard macroeconomic money multiplier model knows what I mean. As the money gets lent out, it just comes right back in again, right? And again, all we really care about is the interest rate. The sort of joke about this is that banks make money so long as the rate that they remunerate deposits is low, and the rate that they remunerate loans or charge loans is high. And so the 3-6-3 model is that they take in deposits at 3%, they book out loans at 6%, and they tee off at 3%, right? It's a really boring business model. And that explains why it's actually so unrealistic in the world today, right? In the world today, we have something that looks much more like a push-pull model. And in the push-pull model, banks have these very complicated relationships with non-financial corporations where they're not just lending money to non-financial corporations, and they're not just taking money from non-financial corporations, but they're actively managing the money of these non-financial corporations and providing them with a host of other financial services as well. And a lot of the bank income comes from the way they interact with these non-financial corporations. But crucially, that's still a very traditional model. So if you were to look at the writings of people like David Howarth and Ian Hardy, they would say this is the bank-based system that used to exist, where all of that activity in the 3-6-3 model that I described is on one side of the equation. And on the other side of the equation, there's this new relationship that's become ever increasingly more important, where banks interact with other banks, right? And when banks interact with other banks, they trade liquidity, they trade investment opportunities, and they do all kinds of complex financial services with one another. And effectively, in this way, they engage in a different kind of market, right? And so Howarth and Hardy describe this as market-based banking, and a lot of the readings that we've had from them now have shown how a lot of banking activity has moved from bank-based activity to market-based activity over time. Well, in that context, it's not unreasonable to imagine that banking is much more sophisticated, and all the stuff we've seen about the evolution of banking regulation shows that a lot of what banks do is risk management in a very complicated way, right? It's not this boring 3-6-3 stuff. It's very complicated, and the larger the banks get, the more their risk management becomes central to their business. Well, if that's the case, right, then there's something really interesting that we can do. And that is we can manipulate the relationship among banks in this market-based context by changing the deposit rate. Now, here I want you to pay attention, right? Because I kept talking about all that central bank liquidity. The deposit rate, remember, is a tax that's charged on central bank liquidity that's stored at the central bank, right? And so why do you want to tax that? And the answer is because you want to push that central bank liquidity out from some banks and into other banks. And you're going to push that central bank liquidity out from some banks and into other banks so that these other banks will have the resources that they need in order to engage in lending with the non-financial corporations, right? So you're going to redistribute funding across the banking system. And when they started to introduce negative deposit rates in 2014, a really interesting thing happened, which is that the interbank rate, which actually floated above the refinancing rate and between the refinancing rate and the marginal lending facility, began to drift down below the refinancing rate and began to float between the deposit rate and the refinancing rate, which showed that the deposit rate was influencing this interbank activity to a huge extent. And then it became a question, okay, how do we get the money out of the banking system and into the non-financial corporations? Because as much as we might influence the relationship among banks, that doesn't necessarily generate economic activity. And that's where the lending rate becomes important, because if we move the lending rate, and then effectively what we can do is subsidize this relationship between banks and non-financial corporations. And the 12 March decision is actually really interesting in that regard, because what the ECB has done is set the lending rate as a standard discount on the refinancing rate by 50 basis points or 0.5%, up to a standard discount, no, I think it's 25 basis points or 0.25%, up to a standard discount on the deposit rate, right, which is negative 50 basis points. So the discount of 25 basis points means that you can subsidize lending from banks, private banks, to non-financial corporations to the tune of something like 75 basis points, which is 0.75%. That's a huge subsidy, right? And crucially, since it's a standard discount on the deposit rate, what we can do is to lift the deposit rate, if we want to, and influence the relationship among banks without affecting the subsidy, right? Because the subsidy will be a standard discount, right? We can even expand the discount if we want. And so in that way, the deposit rate and the lending rate aren't exactly decoupled, but they're pointing at different kinds of economic activity, one of which is forcing banks to redistribute liquidity, and the other of which is getting banks, convincing banks, encouraging banks, incentivizing banks to send that liquidity into the non-financial space. So what does this tell us about central banking? Well, what it tells us about central banking is that they're never out of instruments when they can create liquidity, pay subsidies, or raise taxes, right? Helicopter money creates liquidity. The standard discount that we have right now on the long-term refinancing operations that push money into non-financial corporations is the subsidy, and the negative deposit rate is the tax, right? And so in that sense, the central banks can manipulate these instruments as much as they want, and there's really no limit to what they can do in terms of liquidity creation in technical terms, right? The only limits that are out there have to do with the will to use these instruments in ever increasingly unfamiliar ways, right? And that will is a complicated thing because it's wrapped up in the distinction between monetary policy and fiscal policy. When we're talking about these things, remember, these are very unfamiliar to people who study central banking from the traditional macroeconomic perspective. They don't look like monetary policy. They look an awful lot like fiscal policy. And that may sound like a difference without a distinction, or a distinction without a difference to you. But in the context of the arguments that economists have made about central banking, that kind of a distinction is hugely important, not least because one of the central arguments that they've made is the argument in favor of political independence. And that argument in favor of political independence assumes that there is a clean distinction between monetary policy and fiscal policy. If central banks are engaging in something that looks like fiscal policy, then the argument for political independence is very hard to defend. And alas, helicopter money and dual rates are essentially fiscal policy. And that's what central bankers have been telling us all along. Their fiscal policy, because there are different forms of tax and spend, and in that context, even central bankers find it difficult to justify why, as politically independent agencies, they would be engaged in this sort of activity. So couldn't we do the same thing with fiscal policy? Of course we can, right? Governments can spend money, and when governments spend money, that's a lot like creating the liquidity that we see at central banks through helicopter money. Governments can pay subsidies. They can definitely attach subsidies onto lending, or they can attach guarantees, and we're seeing them do all that right now. And governments can raise taxes, right? They can create incentives to change the way we distribute money, and that none of that has to necessarily involve central banks, except perhaps as the agents of government, right? And indeed, if you were to look at what's going on in Britain right now, when the Bank of England does very controversial things, it does it as the agent of the Treasury, right? It doesn't do it as the Bank of England per se. And in that sense, I think we should accept that all of this could be done through fiscal policy if only the fiscal authorities wanted to do so. Indeed, fiscal authorities can even print money, right? Now, this is kind of a funny thing Paul Krugman raised in the context of the debt ceiling debate. What you can do in the Constitution, the Congress has the right to instruct the minting of coins, and so what you could do is just print $1 trillion coin and then deposit it at the central bank. The whole conversation about monetary theory is not something I want to go into right now, but it's closely tied to this idea. Governments can print money to a certain extent, right? But unlike monetary theory, I do believe governments have three big constraints on their ability to do these things that look a lot like helicopter money and dual rates, right? And those three big restraints have to do with the distortions that the government would create in the markets, same constraints that central banks face. They have to do with the impact that this kind of activity will have on future inflation. That, again, is something that central banks have to face as well. But there's a third thing that central banks don't have to face, which is that governments have somehow to access capital markets in order to do this activity. And here's where I depart a little bit from modern monetary theory and from the minting of the $1 trillion coin. At a certain point, governments have to retain the confidence of financial markets in order to get access to the kind of funding that they require to engage in these activities, at least over the longer term, right? So what does that imply about the politics of macroeconomic stabilization? I think it helps us to understand two issues that are central to the European debate. The first issue is if you worry a lot about future inflation, you're also not going to like helicopter money, and you're probably going to worry about dual rates, right? And I think this, to a large extent, explains a lot of the German reluctance and Dutch reluctance and Austrian reluctance over the summer to embrace the further accommodation that Mario Draghi introduced, and also a lot of their reluctance in this more recent round of monetary policy easing. But having said that, I think we should all agree that setting priorities is a political decision, right? And if you're going to prioritize future price stability over current price performance, then implicitly that's a political decision as well. That's one the European Central Bank is authorized to make because the central bank has been told that it's supposed to prioritize price stability, but it's also been told it's supposed to define price stability. And what Christine Lagarde had been trying to do was to initiate a conversation about how price stability should be defined in this modern financial age. That conversation has been preempted by the crisis to a certain extent, and we're left in this sort of vague situation where there's a real political fight, and it's an honest political fight taking place within the governing council about what price stability means, and it's a fight that they are legitimately allowed to have, although it does have implications for broader political considerations that I think have to extend beyond the ECB and into the constitution of the monetary union as a whole. The second point is that you're likely to rely on fiscal policy rather than monetary policy if you have an easier time accessing capital markets, right? And here I am sympathetic to the modern monetary theorists. Because anyone who wants to use fiscal policy is going to have to prioritize market access, and you're only going to engage in the kind of activity that modern monetary theory suggests if you can't access modern capital markets, right? If you can't borrow the money, then you're just going to create the money, and you can create the money, but obviously that's going to jeopardize a lot of the confidence that people have in the money in the first place. So you don't want to do that if you can avoid it, right? If you can avoid it, you want to be in a situation where you can actually finance government expenditure in a way that looks credible over the long term. And those countries that are most able to credibly finance or to finance credibly their fiscal situation are going to say, look, there's no problem here. We have the ability to access capital markets. We are concerned about future inflation, so we're going to access capital markets. We're going to use fiscal policy, and we're not going to resort to helicopter money or dual rates. In other words, these issues put Germany and Italy at opposite sides of the debate because the Italians don't have the luxury of accessing capital markets the way Germany does, and telling the Italians that they lack that luxury because they haven't prepared in the past doesn't solve the problem that they need that access in the present, right? So in that sense, what we're really engaged in when we're talking about helicopter money and dual rates is a proxy for a much more serious debate about how we make sure Italy has access to capital markets, because if we don't have access to capital markets for Italy, bad things are going to happen. And this is a political debate, right? Italy should have access to capital markets. It's not a technical debate because Italy does not have access to capital markets in the way that Germany does, even with all this monetary policy support that the European Central Bank is offering. Italy still has to pay a premium over Germany of about 200 basis points or 2%. And so in that sense, Italy is relying on the generosity of the ECB, but that generosity of the ECB is not going far enough. And if we don't want to overstretch the ECB as an institution and push it into doing things that are even more awkward, both in terms of the way most of us as macroeconomists understand what monetary policy looks like, and crucially in terms of how the public looks at the ECB as a monetary policy authority. If we don't want to go in that direction, then we need to be sure to give Italy access to capital markets so that it can do the things it needs to do fiscally, rather than trying to convince monetary authorities to behave in a fiscal way. That's why this debate is so important. Many thanks for suggesting the topic. The course lectures are going to show up only over the weekend.